We've had these numbers released and coming in below expectations on a quarter-on-quarter basis. So 1.4% for the third quarter, seasonally adjusted, where consensus was for 1.8%. Overall impressions of the number that's been released here?
Yeah, it's a little bit disappointing. We had, for example, 1.8% penciled in on the basis of mining and manufacturing coming off. That was pretty much known ahead of it. What typically isn't really known is the agricultural component of GDP, and that's where I think quite a bit of the disappointment came through. So that was part of it, and then I think on the manufacturing side we hadn't factored quite as bigger a number because the last two data points had been a little bit better. So slightly disappointing on that side.
What really stands out is that mining number, though. I mean, mining down 17.4%, and it had to an extent been anticipated. I was chatting to Mohammed Nala off air, and he was saying that if you looked at the kind of production numbers that have been coming through from our miners, it almost set the precedent already. Absolutely.
I mean, we actually did have the mining output figures from Stats SA pretty much up to date, so that number didn't surprise, but nevertheless it is a disappointing number, and I think it does indicate that things have actually wound down somewhat over the last quarter or so, both domestically as well as internationally.
Not surprising, but certainly disappointing, and disappointing because it seems that we're failing to capitalize on these high commodity prices that we are seeing and the demand that's filtering through, where that demand is coming through from. So the likes of your Asian economies specifically, and the implications for job growth going down the line has got to be dire, because we know that the mining sector is certainly a big employer in South Africa.
There's no question. I mean, we've got the perennial problems of infrastructure not being sufficient, particularly on the transport side, but as you know, of course, we've also got electricity constraints, which is limiting the amount of investment in that sector. We are starting to see, though, one or two bigger projects coming through over the last couple of quarters. But in general, most plans are on hold until people get more certainty about what's going to happen internationally, and then, of course, more certainty as to whether you can get the stuff out locally.
I mean, I'm concentrating on this mining sector because it's a big employer in the country. It's going to have a ripple effect on the other sectors as well. So let's take a look at wholesale retail sales. I mean, that came in higher, not unexpected as well, 6.1% growth filtering through there. But that could come under strain moving forward if you've got a sector like your mining being a big employer cutting back.
Yeah, I mean, the big generator of retail spending is, of course, disposable income, and the big multiplier there would be employment, as you rightly suggest. What's been supporting it, though, has more been good wage and salary growth over and above inflation, and now we're starting to see inflation go up. So that's eating into disposable incomes, and at the same time employment growth has been very, very weak for this stage of the upswing. And of course, if we go into the dreaded double dip scenario in Europe, that could present somewhat of a problem going forward as well.
Of course, we've had data show this morning as well, a slight increase in the demand for loans out there, with private sector credit extension rising 5.52%. What do you make of that? Because, that's happening in a context where we're seeing the kind of retail sales growth that we are, and implying that maybe South African consumers are becoming a little bit more cautious as to how they're accessing credit, where credit is being extended, and how they're spending in the current economy.
Yeah, the numbers were especially weak in the mortgage area. If you analyse the figures, that's where basically things really are not moving at all. 2.1% over the year, exceptionally weak. Where there was some life coming through was instalment sales credit. So that seems to be picking up somewhat, maybe in anticipation of the festive season, and we've also seen that things like motor vehicle sales haven't been too bad. But overall, for this stage of the cycle, these numbers remain exceptionally weak, and I think it's both a demand side issue as well as a supply side issue, because the banks themselves are very much constrained by these impending liquidity requirements and all sorts of regulatory demands. So it's making them more cautious about extending credit.
Where you did say we're looking at the rise in loans come through, it's from those from installment credit being extended. Just how much of a red flag does that put up? Because it implies that we're looking at short-term lending taking place as opposed to longer-term lending.
Look, not too much in that particular category. The area which I think has caused a few eyebrows to be raised in general has been personal loans, which have been running very, very strongly. But it's a relatively small component of the market, but nevertheless has been increasing quite significantly. So there's a category called other in the general advances, and that rose quite strongly during the month. We actually saw that in excess of 12%, so it was quite a strong figure.
Yeah, of course, with this coming through, I mean, we've got the risks focused on inflation at this stage of the game still. That's where the SARB's focus is. What's your view on whether or not we're entering or running the risk of sitting in a stagflation environment for longer, possibly than anticipated originally?
Yeah, I think the Reserve Bank's attitude at this point is, sure, we're going to be breaking into above 6%, which is outside their target range. But their focus is more about the 12-month to 18-month sort of period where they can really start to influence things on the interest rate side. And in that area, they actually anticipate inflation to come back below 6%. I think for that to happen, though, we need to actually see some moderation in things like food prices. We need to see some moderation in the oil price. Because those have been where the big drivers have come through, and we also need to see a relatively stable exchange rate so that the exchange rate doesn't continue weakening. So a lot of unknowns in that. But for the moment, to me, there's still no real signs of that demand pull type of inflation, which would cause the Reserve Bank to start pulling the lever on interest rates. So I think they're more likely to keep a steady sort of profile on the interest rate side, given the weakness on the growth figures and given all the uncertainty about the international economy.
I just saw some commentary come through from Nomura saying that we need to see substantial weakening in that fourth quarter GDP number to open the window for potential rate cuts in the first half of next year. Are you in line with that kind of reasoning?
I think the fourth quarter is neither here nor there. It's likely to be, we think in actual fact, it's probably going to be around about 2.5%. It's probably be a bit better than the third quarter. I think the key signal will be, though, that Europe is going into a deeper than expected recession. And there I don't think the Reserve Bank would particularly wait for GDP figures to come out because they'd know the effect coming through. But it's more likely to be in conjunction with other central banks around the world simultaneously relaxing monetary policies, particularly in emerging markets. I think they're very unlikely to do a go-it-alone type of move.